Our group, Group 3, has chosen to do our project over Apple Incorporated and Samsung Electronics Company. They are both two publicly traded companies who have dominated the multinational electronic and technology industry. Apple is the bigger company of the two. Samsung serves as its number one competitor. Apple was formerly known as Apple Computer, which was founded in 1976 and officially incorporated in 1977 in California.
My name is Jamel Roberts, and I will be going over some of the ratios for Apple. The current ratio measures a firm's ability to pay its short-term debt obligations that are due in a year or less. Last year, Apple had a current ratio of 1.12, which was a decrease from its 2017 current ratio of 1.28. This was also the largest decrease it has experienced in the past 5 years. In 2016, Apple experienced its largest current ratio in the past 5 years, being 1.35, which was a large increase from 1.11 in 2015. But its current ratio has been declining each year since 2016. In 2014, Apple had a current ratio of 1.08, which was its lowest in the past 5 years, but it increased the following 2 years until it reached its peak in 2016. Compared to its top competitor Samsung, Apple's current ratio is always higher. Both companies experienced a 5-year low in 2014 and a high in 2016. But unlike Apple, Samsung had an increase in 2018, going from 0.95 to 1.06. And as you can see in this graph, Apple had its peak current ratio in 2016, while it had its lowest in 2014. And after 2016, it experienced a decline each year. The average collection period measures the average number of days it takes to convert its accounts receivable into cash and the average number of days it takes customers to pay their credit accounts. Apple had its highest average collection period in 2018, being 31.65, and its lowest in 2015, being 26.31. Samsung's average collection period is significantly higher than Apple's, having its highest in 2018 at 52.27 and its lowest in 2016 at 43.91. The accounts receivable turnover ratio measures how many times a year a company collects its debts. It is calculated by adding the beginning and ending accounts receivable of 1 year period, dividing it by 2, and then dividing it by the net sales. Apple's accounts receivable turnover was at its highest in 2014, being 0.084, but increased to 0.073 in 2015 and remained mostly stable the following years. Samsung's accounts receivable turnover remained between 0.11 and 0.13 in the past 5 years, with its lowest being 0.11 in 2017. The inventory turnover ratio measures how fast the company sells and replaces its inventory. Apple is extremely efficient in managing inventory. Its inventory turnover is almost 3 times greater than Samsung's and the other companies in the same industry. Apple had its highest inventory turnover in 2016 with 10.11, while Samsung only had 3.32 during its lowest year.
My name is Victoria Adams, and I'll be going over some of the ratios between Apple and Samsung. So Apple and Samsung are true competitors, meaning there's always a competitive advantage or disadvantage for every aspect in both companies. Throughout the years, the numbers for both companies vary by either increasing, decreasing, or seldomly remaining constant. The total asset turnover for both companies appear to be doing well for both Apple and Samsung. A high asset turnover ratio is a positive sign as it indicates an efficient use of assets as well as business growth and proper management of assets. Both corporations display over 60% use throughout the years. Fixed asset turnover is an evaluation of how well a firm is using their fixed assets, or it can also be known as an efficiency ratio. For Apple in 2014, the ratio was calculated at 0.48 and rose to 0.58. And the following year, 2016, the ratio decreased to 0.46 and once again in 2017 to 0.43. For Samsung, these numbers were much different. In the year 2014, Samsung's fixed asset turnover calculated at 1.13 and decreased to 1.09 in the following year. Preceding that decrease, there was a major increase for Samsung with ratios that were calculated at 2.21 and 2.25. Lastly, in 2018, the ratio reached its lowest point, which is 0.87. The basic earning power is an important measure calculated to determine tax situations and the firm's basic profitability of their assets. A higher earning power is a sign of effective management for a company's assets. The better use of assets means more income is being generated. To find this basic earning power, you divide the firm's earnings before taxes by total assets. Apple's highest basic earning power was in the year 2015 at 0.25, and for Samsung, the basic earning power was highest in 2017 at 0.19. The fixed charge ratio is a measurement to determine a firm's capabilities of paying off expenses and fixed charges. An example of fixed charges can be employee salaries, insurances, or mortgages. A company should be in good standing with their fixed asset ratio if the company brings in at least 2 to 3 times the amount of their expenses. Samsung's fixed charges were highest in 2017, while Apple's were the highest in 2018. Debt ratios indicate the overall financial health of a company and how trustworthy a company is with their loans, financing, and also returns that can be paid out to shareholders. Having no debt at all does not make a company more favorable because this means there will be less returns for investors and no sign of an increasing overall operation for the company. One factor that may impact a company's debt ratio is the payment history. This ratio is calculated by dividing total liabilities by total assets. A better debt ratio is considered to be 0.4 or lower, while a higher ratio is considered to be 0.6 or higher. Apple has a seemingly high debt ratio coming in calculated at over 60% during the majority of the years. Samsung's debt ratio is much lower and beneath in comparison to Apple. The ratio averages at 27% for the years between 2014 and 2018. The long-term debt-to-equity ratio is used to determine how much leverage a company has, and this information may be useful when determining if a company is at risk for bankruptcy. This is due to a higher rate implying that the business will not be able to repay loans as well as accruing interest rates. To find this calculation, you divide long-term debt by common stock plus preferred stock. For this calculation, it's more ideal to have a ratio that is 2 or less. For Apple, in the first 3 years of the analysis, which would be 2014, 15, and 17, the ratio was high, above 2 for all 3 years. In 2017 and 18, the ratio was calculated well above 2 at 4.85 and 8.20. In 2018, the long-term debt ratio reached its highest point. Samsung has the best overall long-term debt ratio in comparison to Apple, with theirs being under 1. With this information, it is safe to assume that Samsung's supply of products is in less demand than of Apple's products. Times interest earned is a measurement that is useful for determining how well a company will adhere to their payment agreements. The larger the ratio, the more likely a company will have the ability to pay down their interest that is owed. This will make a company more favorable to investors knowing the company can honor their agreement and making them a good credit risk. This number is found by dividing income before interest taxes by the interest expense. Apple does a much better job of managing a better ratio. Samsung's value come in below and will be considered highly valuable. It is safe to assume that this is due to the much greater revenue that Apple brings in when we look at it compared to Samsung. The total profit margin is simply the accounting of funds remaining after costs. Apple's profit margin has increased over the years, while Samsung has not been consistent. The operating profit, or the return on sales after costs, have been accounted for. For Apple, the operating profit margin has remained well and over 25% throughout the years. The highest year was 2015, with the return on sales reaching up to 30%. Apple's profit margin is so high due to the cost of making their phones and other products, which are popular sellers. For Samsung, the operating profit margin has been fairly low compared to Apple. However, in 2018 and 2017, operating profit margins did reach above 20%, making them the #1 competitor for Apple. Okay, so here I have a graph that shows Apple's profit margin over the past couple of years. So here you can see how Apple's profit margin has been pretty constant throughout. It's been over 45%, at least from 2014 up to 2018. And then I also have a graph of Samsung showing how inconsistent their profit margin has been. So you can see here in 2014, it was really low, I guess like around 37, 38%, and then it went up. However, its highest was in 2017, right above 45%.
All right, I'm Malcolm Tate. I'm going to be discussing the accounting measures. So first, we're going to start with total net operating capital, which is a measure that shows the capital used for daily operations. Apple has pretty much increased every year, which is normal for a company that continues to grow in the fashion Apple has year over year. Since 2014, Apple's total net operating capital has grown from 41 billion to over 60 billion. During the same time period, Samsung has also grown year over year at a pretty steady rate, growing from 34 billion to 54 billion in 2018. Now we're going to switch to net working capital, which shows the amount of capital the business uses in day-to-day trading operations, which is calculated by current assets minus current liabilities. Apple's net working capital steadily increased year over year, which is a good sign for investors. During this time, its competitor Samsung has also increased. In 2014, Samsung was at 63 million. In 2018, 105 million, which was a 42 million increase over a 5-year span.
Hello, my name is Jasmine Thompson, and I will be going over the net profit margin, the return on asset, return on equity, and also the work cost of capital. Margin is a percentage of income after the working cost of capital is deducted from the company's complete income. The meaning of a good margin varies from industry to industry. On average, a good margin profit is 10%. 5% is considered to be low, 20% is considered to be high. As we can see for the net profit margin for Apple, they have a relatively good margin, some in which are higher than others. Where in 2018, it was high of 16.28, and in 2014 and 15, there was a high of 17.04 and 18.38. Return on equity. The return on equity is a measurement of how well a company is doing. This is done by dividing the net income by the shareholders' equity. The average is 15 to 20% on the return of equity. So for Apple, we have a return of equity that are all seeming to be very high. The highest one that we can see for Apple was 49.5 in 2018, and the low they had was in 2014 of 33.7. With Samsung, the return on equity is the highest being in 2017 of 21.01 and the low of 11.16. Okay, the price earnings. The price earning is calculated by dividing the share price by the company's earning per share. Having a higher earning tends to indicate the increase in demand, which indicates a growth in earnings. The average price earning is 13 to 15%. So as we can see for Apple, they said about average from 13 to 15%, which they fell slightly short in 2015 with 11.24, and with Samsung's price earning, they fell drastically from 2014 to 2016. They stayed relatively high, with the high being 11.42, but in 2018 to 2017, they drastically dropped to 0.08 and 0.06. So as we can see, Apple has a higher price earning, which means that their demand is higher than Samsung's, especially over the course of the last 2 years. Okay, next we have the market value to book value. With the market value to book value, this is used to evaluate the current value of the company to its book value. To find the market value, you add all the current stock prices of the outstanding shares and divide them by the book value. Apple, as we can see, has a higher book value, a market to book value, and with the Samsung, as we can see, their market value to book value was slightly lower than Apple's. Okay, so then we have cash flow per share. The cash flow per share is measured the amount of cash generated in the company. The cash flow per share is relatively under 20%. So as we can see that Apple stayed under 20%, which is meaning that the cash flow is, the money going through Apple is being accommodated correctly, and the company is ran sufficiently. And we can see in the cash flow per share with Samsung, cash flow per share with Samsung, they kept theirs relatively low as well. Dividend payouts. The dividend payout is calculated by dividing the dividend per share by the net income. If the payout is more than 50%, it's considered to be high. This means that the company is paying more dividends than retained earnings. As we can see for the dividend payout, they were all extremely low, which means they're not paying more in dividends. They have more retainers than dividends, meaning the company is generating money correctly. So as we can see, they were all relatively low, with the lowest being in 2015 at 6.01. And Samsung dividend payout was slightly higher than Apple's, but never reached over 50%, with the high being 21.92 in 2018. For the dividend yield ratio, the dividend yield ratio is the percentage of money that the company pays shareholders for owning stock in the company. The dividend yield is 1 year of investment paid back in dividend payments. The dividend yield is measured by calculating the annual dividend shares divided by the price average. So as we can see, Apple has a low dividend yield ratio, with the lowest being 0.25 in 2014. And as far as Samsung, theirs was slightly higher, with a high of 3.95% in 2017. So for our weighted cost of capital, our after-tax cost of debt was 3.21%, and we got that by dividing the total book value by the interest expense. Our cost of preferred stock was 0, and that's just because that's what Apple has. The cost of internal equity was calculated by taking the current risk-free rate plus the beta, which was 1.13, times the market premium of 6%, which gave us 8.7%. The cost of external equity for CAPM was beta of 1.13, the risk-free rate of 1.92, and the risk of return, which was 5.98. And we got the market risk premium by subtracting the return on market by the risk-free rate, which gave us the market risk premium. And oh crap, I scroll up. You can edit that little part out. Hold on.
You want me to stop it?
Yeah. Margin is a percentage of income after the working cost of capital is deducted from the company's complete income. The meaning of a good margin varies from industry to industry. On average, a good margin profit is 10%. 5% is considered to be low, 20% is considered to be high. As we can see for the net profit margin for Apple, they have a relatively good margin, some in which are higher than others were in 2018. It was high of 16.28, and in 2014 and 15, there was a high of 17.04 and 18.38. For Samsung, thank you. For Samsung, they had a relatively low. Did I go too much? We can edit that part.
Take 3 or just.
You can edit that part out. I don't care. Relatively lower, with a high in 2018 of 7.75 and a high also in 2015 of 18.95. Return on investments. The return on investment is measured using the measurement of efficiency investments to compare different investments to one another. A good return on investment is considered to be 15% or higher. For Apple, the return on investment, they were all relatively high. As you can see, they were all higher than 15%, with the highest being 2015 of 43.20. And for Samsung, it had a high of 24.5 in 2018. Return on assets. The return on assets is known as the ROA, is how profitable a company is in comparison to the total assets. The ROA gives the company insight on how the company is managing their assets of gain. The average 5% ROA is higher, is considered to be good. So as we can see, we have the ROA, they all are higher than 5%, with the only one being low of 7.91. And for Apple, we have a ROA all higher than 5%, with the high being 20.5 in 2015.